Good morning and welcome to the Prescient Investment Management interest-bearing webinar for Q4 2022. My name is Natalie and I'm joined here today by Bastian, Reza and Henk. After a whirlwind year of rising inflation and interest rates globally, 2022 has come to an end. It was a tough year for markets and fixed income investments specifically, having to contend with near record high inflation in the US and the subsequent aggressive interest rates hikes by the Fed and the SARB. Although we've entered into a new year, the pressures we faced in 2022 are still lingering. So let's chat about our global growth expectations for 2023. Basti, can you take us through this?
Yes, sure. Thanks, Natalie. It's good to have a fresh start to 2023. As you said, 2022 has been extremely challenging. So unfortunately, our view is that global growth is going to continue to slow down quite significantly. And that's where global policymakers really have resigned to. If you read any market outlook from the bigger banks or bigger asset managers, everybody is expecting a recession this year, and there's just a very few outliers. So what's our take on it? I'm going to show you just now. But before we go there, let's just also recap what happened and why this is probably a quite reasonable assumption. We have went through the steepest hiking cycle in living human memory, or call it at least the last 20, 30 years. And hence this sharp sell-off in fixed income assets. And with that, you would eventually expect these higher rates to work their way through the system into the real economy, and that's exactly what we're seeing. So with that, we had the steep COVID rebound in 2021, where we saw basically 6% growth in the States, sharp V-shaped recovery. But then in 2022, we saw the slowdown down to only just below 2% growth. Now with this weak momentum going into 2023, we expect growth to also be negative. But why that? I guess once again, we like to look at the facts, we like to look at data. So just allow me to show you two charts. So at Prescient, we like to look at the Prescient Economic Indicator. The Prescient Economic Indicator is our own in-house nowcasting. And it's a model suggested by Stock and Watson, and it helps us to get a good understanding where the economy is in real time. So I'm going to zoom in a little bit for you, and you can see that the model is fast to react. We basically track, for example, the burst of the dot-com bubble quite quickly. We do track the great financial crisis quite quickly. And then during the COVID crash, also our model is fast to react. So it's a very responsive model. We use it a lot for multiple asset classes. And what does this model suggest today? If I zoom in a little bit further, you can see that we have dropped below trend growth. So telling us that as we speak, the US economy is already experiencing quite a significant slowdown. It's definitely growing below trend already. We do think, though, and this is just if you look at the extent by which we are below the red line, that we shouldn't get ahead of ourselves. This line can also turn up again. We do not see this as a particularly deep, pronounced, or long-lasting recession yet. Okay, adding to the worries, though, or other indicators, we also like to look into the Citigroup's Economic Surprise Index indicator, which basically measures what are economists' expectations and how do actual data prints compare to these expectations. So if you're below the zero line here, it just means that economic data prints are coming in weaker than originally expected. And if they are above the zero line, they're coming in stronger than historically expected or expected by global economists. And what you can see is that we're moving down here. So we are below the zero line, not significantly, but economic data is therefore not just weak as we speak, it is also surprising on the downside. So just another signal that there are some worries, and the worries are warranted. But before I go there, once again, another indicator, we also like to look at profitability, profit margins of US corporations. Well aware that this is a more fixed income centric webinar, yet we do like to use profit margins just to get a glimpse of the global business cycle or the global economy. And we do like to look into the S&P 500 here because those are the most global corporations. You can see that the business cycle could potentially be rolling over, measured by the drop in profitability of these corporations. So a lot of signs telling us that the business cycle is potentially coming to an end, that we're heading into a significant slowdown, potentially a recession. And with that, obviously, we must be more cautious. We must be cautious from an economic point of view, but obviously there are other factors. We also like to look at monetary policy as an example, valuations, and these factors obviously can paint a different picture on a set of asset classes like SA bonds or SA income.
So potentially lower growth, but what about a pivot in global monetary policy? This could be a strong driver of asset class returns in this next year. Is this something we could expect to see soon?
That's a good point. So it is definitely a given that monetary policy once again will have a definitive role in terms of asset class pricing, and most likely will also be definitive for our bond or income returns in South Africa. Before we can speak about Fed pivot, we need to quickly look into inflation once again. I don't like to look into inflation that much right now because that's what we've spent the last year on, actually. But it is just important. So the Fed will react to inflation, so we have to understand inflation into detail. I like to use an analogy from John Williams from the Federal Reserve of New York. So he kind of paints the picture of inflation around a three-layered inflation conundrum. So he says that the outer shell basically being commodity prices like oil, maybe energy costs in Europe, potentially the fuel price, that this very outer shell has already started to come down. So we see inflation dropping in these items of the CPI basket. But now we need to go to the more inner shells as well. So the next shell is basically the direct derivative of these commodity input prices. There we would look, for example, as consumer goods, something like new and used cars. And this first derivative of the very outer shell, the second layer, so to say, of the inflation conundrum, these parts of the basket are also coming down rapidly. And that's exactly why we see top-line inflation coming down. But the last most central part to inflation, the core of the inflation story, has remained a little bit sticky. This part of inflation is heavily driven by the housing market or shelter directly, which is owner's equivalent rent. We see a lot of cracks in the housing market. We do expect inflation at the core to also come down this year, but this is clearly where the risk lies. Okay, that core inflation remains more sticky. I would once again like to just show you that in two charts. Okay, so we'll start to look a little bit more detailed into inflation through a few charts. It's just crucial, so just to show the pictures to what I've just been talking to. So I'm going to start by just showing a zoom in onto CPI inflation. You can see that, I'm just zooming in a little bit more, you can see that we have started to come off the peaks. So if I really show the last couple of months here, you can see that our peak inflation was at 9.1, which was here, but now we have seen quite a bit of a decline to 6.45. So inflation is moving into the right direction, but this in itself is not enough. So let's really look into the decomposition of inflation. It's really key to understand the full story. So here I want to once again speak towards those three layers. So let me start by showing the very outer shell, motor fuel, as an example, is a big part of the CPI basket. You can see when I go to roughly peak inflation, which was like in May last year, you can see that the contribution from motor fuel is like 1.7%, so quite a big contribution of admittedly very volatile component of the basket. You can see if you just follow the green line that we are now dropping sharply towards a contribution of just 0.6, and if you bake in the basis effects on the oil price, which we're going to see, we might actually go negative on this inflation contribution. So the very outer shell is definitely heading into the right direction. Let's look at the second layer. I'm going to look at new and used cars as an example. Quite topical, as again closer to the peak of inflation driven by supply chain disruption. We had a contribution of 1.72% to the CPI basket just from new and used cars. Okay, so this was basically post-COVID. Everybody wants to get a car instead of taking public transport, but supply chains are disrupted, and then you can't get a car, so prices have to go up. So these prices for these goods have also started to decline. So you can see we have a 1.72 contribution here in Feb 2022, and now we are declining sharply to basically no contribution. Again, an item which is going to be deflationary soon. So a sharp drop in the second layer as well. But last but not least, let's look at the last layer, the inner layer, the core of inflation. And for that, I'm just going to look at shelter prices and proxy that. So you can see once again closer to peak inflation, we have a contribution of roughly 1.62 And has that dropped? Well, if you just follow the line chart, you can see it hasn't. So it's actually going up. And as we speak, even with the last data point, we actually have the biggest contribution of 2.15% to top line inflation just from shelter. So core inflation has remained sticky, and that's exactly where we see the key risk. As I said, it's not our base case. We do expect core inflation to come down, but if core inflation remains more sticky, there is a risk that the Federal Reserve doesn't deliver on the hikes which it has been priced for.
Thanks, Basti. So these inflation dynamics are directly influencing the Fed's decisions regarding monetary policy. Can you give us some more insight into this? Would you say we're currently in a tight environment or not?
We don't think we're in a very tight environment yet. We're not worried that monetary policy is too tight yet. We're just more worried, and that's what I mentioned by the cuts which are priced into the market. We are just worried that the market is getting ahead of itself by pricing us for quite a few cuts which might not materialize. So just to explain this a little bit more detailed, yes, there's going to be a significant economic slowdown, potentially a recession, but the market is priced for 8 cuts. For that, we would need to see a very deep economic recession, or, which we can't pick up with the data yet, or alternatively, we would see a quite deflationary environment, at least a very strongly disinflationary environment, which might materialize, which could happen, but there are risks to that view because core inflation is not necessarily coming down all that fast yet. You think it's going to come down, but not with the same level of confidence that we would say there should be 8 cuts priced into the market. So our take is here, monetary policy is not necessarily tight. We're not that worried about a recession this year. There will be a slowdown, there will be potentially a mild recession, but what worries us is that the market is expecting an extremely dovish Fed, and the Fed potentially doesn't deliver on that. Again, it's best explained by just looking at 2 or 3 charts. Okay, we're going to look at what we call our central bank monitor, within which we track quite accurately the behavior of global monetary policy. And I would love to focus on the United States within this indicator. So best way to basically look at the tightness of monetary policy is to look at a decomposition of the natural rate of interest rates, or basically it's trying to say where are interest rates compared to where they should be if you want to run completely a neutral monetary policy. So this is basically what the red line is indicating. That's where you can run interest rates if you want to be, in real terms, if you want to be completely neutral, suggesting right now it's roughly 1% real rates in order to be neutral on monetary policy. Where is the real Fed fund rate right now? It's still below that. So you can see we see quite a bit of tightening here. This is driven by 2 factors. Basically A, obviously the hikes which the Federal Reserve has put through, but then also B, inflation coming down, also driving up the real rate. So the real rate now just marginally negative, basically as we speak, spot on the 0 line, while the neutral rate would actually be at 0.8. So if I now focus on the gap between those two, you can see that monetary policy is basically still in expansionary territory. So no, monetary policy is not tight. Monetary policy is not very, very tight. It's not what we can see. Okay, so where's the issue then? I just want to focus on the pricing. That's exactly what I just mentioned earlier. So for this chart, I would love to basically just focus on the effective Fed fund rate. So you can see this red line is sitting at 4.33. This is basically telling us that the real effective fund rate is in a range between 4.25 and 4.5, exactly what the Fed is targeting. And then the dotted line is telling us what the market has priced for the Fed fund rate to be at a certain point in time. The market is telling us the Fed fund rate is going to go all the way up to 4.9% over the next 6 months. But the interesting story is that then over this 12 months to follow, or 18 months to follow from there, all the way until the end of 2024, we see the Fed fund rate going down again to 3%. So this 2% difference from 5% to 3% in just 18 months means that the Fed would have to deliver 8 rate cuts, which is a possibility, but it's quite start to see this as a consensus view, or like a view which is already priced into the market. So another way to visualize it is in this chart. I'm just going to take out the 12 months forward expected return, 12 months forward expected Fed fund rate. Going to just compare the 3 months expected Fed fund rate, still higher than the current rate. Okay, so again, being at roughly 5%, and then 24 months ahead, we'd go all the way down to just 3%. So if you just focus on the gap between the red line and the yellow line, it's just very wide. So meaning that 24 months out, the Fed fund rate is set to be much, much lower than 3 months out, which implies a lot of rate cuts. And again, it's difficult to see that without a very steep recession or without a very disinflationary environment.
Thanks, Basti. So Reza, I'd like to get some insights from you. What do these developments in the global macro landscape mean for South African bond yields specifically?
Thanks, Natalie, and thanks, Bastian, for outlining some key macro considerations. And I think I'd like to start by saying that it's been our long-standing contention that South African bonds have a set of pricing determinants that are almost exclusively global in nature, right? So what that means in simple terms is that if we look at the post-global financial crisis period, you had central banks that ushered in a set of unconventional monetary policy tools, quantitative easing and large-scale asset purchases being foremost among them. And what this did was to catalyze this idea of risk-seeking global capital flows, right? And so our contention is that South African bond yields have responded primarily to the global flow of risk-seeking capital. The problem, I think Bastian alluded to this idea of financial conditions, having tightened in the course of 2022, and this risk-seeking capital that I was speaking of responds in turn to financial conditions. When financial conditions are accommodative, you find global capital flowing into emerging markets, into emerging market currencies, into bond yields. The problem and the challenge during the course of 2022 was not simply only that you had a tightening of financial conditions, that is certainly true, but it was this idea that market participants had to grapple, often very painfully, with this idea of an open-ended tightening of financial conditions. And what I mean by that is that if we look at localities like the US, we know that monetary policy is a key building block of financial conditions, and we know that monetary policy unfortunately operates with a lag. So now you had this idea where market participants are seeing a very aggressive Fed, moving in increments that are historically unprecedented, a very aggressive Fed, but unfortunately you still have this idea of inflation remaining elevated and inflation remaining stubbornly high. And so at each iteration, and we could almost see this directly in the bond market, at each iteration of a CPI print that remained elevated, markets then started to question themselves, with regards to, is this very aggressive action by the Fed even having any traction at all, right? And so we found that at each iteration of a CPI print remaining elevated, you found that there was a new flight path, a new trajectory that was priced in by markets with regards to the evolution of the Fed funds rate. Each iteration being sharper, higher, more front-loaded, more aggressive than the previous version. So this created a sort of a negative feedback loop for asset prices, and South African bonds, were not spared from this, right? But having said that, and having said, and I painted a somewhat gloomy picture, South African bonds were somewhat of a bright spot. In fact, where it was actually quite a horrendous time for high duration assets, in general. But at a time where emerging market currencies lost, anything between 7 and 10% of value relative to the USD. So South African bonds, in fact, returned around 4%, and that's why I say a relative bright spot. If you juxtapose that with some other asset classes that sort of lost, double digits, kind of returns. So I think it's best at this stage if I try and show some of this at least, with a graph. So just to illustrate something of what I was trying to say, so if we just look at the graph in front of you, that is a depiction of the sovereign nominal South African yield curve with the various bonds along the term structure as shown, the dotted line representing the fitted line. And then if we look at that same yield curve, basically a year ago, we can get some idea of how the yield curve has changed over the years. So the red line being the yield curve a year ago, and the grey dotted line being the yield curve currently. So what we can see is that there was a mostly parallel shift upwards in yields to the order of around 70 or 80 basis points. And if we just look at sort of, let's just take generically the 10-year area of the curve, you can see that you were starting with yields more or less of the order of around a tad over 9%, and ended the year something where we were at like sort of 10.5%. So what we found was that because of this movement, this relatively parallel shift upwards in yield, you lost about 5% on duration. But what you did get, counting in your favor, was the high coupons and the high initial yields that bonds offered here in South African context. So what you ended up was something with a 9 handle, minus the 5% duration, leaving you with something around 4%, which is a great outcome, as I say, juxtaposed with other high duration assets globally that had sort of double-digit losses. So hence I say South African bonds were somewhat of a bright spot.
Sounds like quite a challenging context, and given what you've said, it sounds like there's still quite a lot of uncertainty in the market. So looking at the flexible bond fund, would you say that it's positioned in a more conservative way, more risk cognizant with lower duration because of this?
Thanks, Natalie. Yeah, so great question, and so yes and no. So what we thought was that whilst we absolutely agree that there are high degrees of uncertainty abound, what we tried to shy away from was just this idea of, in a knee-jerk sort of emotive kind of way, to go into extremely low duration assets. In other words, you're looking at the external environment and you say, there's too much uncertainty, let's just park our money in cash to be safe. Like so, whilst in certain respects that could have been a good outcome, we try and shy away from those kind of behaviorally based, emotive kind of decision making. So instead, what we do here at Prescient, we try to be systematic. We try to use data to its full degree, to its full potential. And with reference to bonds, what we've tried to do, as we've done with many other asset classes, is that we've tried to say, can I distill bond returns into certain determinants that really matter, right? So once we do this and we test various factors for the degree of predictive efficacy for bond returns. So once we've then done this, we can identify these factors, and then it makes the question relatively easy, because then when you enter periods of uncertainty, you can just simply sit back and ask yourself, I've identified my determinants, what has really changed in those determinants? And just to bring this to life somewhat, I can show our viewers our bonds portal page, and I can give some life to what I've been talking about. So just to give some color to what I've been explaining, so this is the landing page for South African sovereign bonds, which is our key decision-making tool. And what I was alluding to just before this was a set of determinants which have proven to have statistical predictive efficacy with regards to future bond returns. So we have 4 key pillars over here, as you can see, and we've grouped certain factors. Within these 4 key pillars, them being valuations, or how high or low yields are, economics, which pertains to the level of real activity both here and globally, financial conditions, and then also metrics related to sentiment that is priced into financial markets, right? So what we can see here is that essentially we've got quite a blue, in other words, a very attractive, a positive score from valuations, meaning that South African bonds currently offer a very attractive real yields. I mean, I think this point is generally well made throughout the industry, but it's something that we bring into account formally here within the model. South African, the term structure of South African bond yields have got quite a high term premium. That is the excess compensation one gets for actually being in longer dated bonds. And also it offers quite a high relative yield relative to sort of base rate bonds such as the US 10-year bond, for example. What we can see pulling in the other direction, and I won't go through all of the factors, but we can see some of the macro comments that we've made earlier on financial conditions being in relatively tight territory. I mean, you see that the slope of the US yield curve, measuring the difference very simply between longer dated bonds and those at the front end, flashing red. So we do find this idea of an inverted yield curve curve being negative for asset prices, and also generally for emerging market locations, you generally don't like a strong dollar. So you have the shape of the US yield curve, and you have a strong dollar pulling away from what would otherwise be a stronger score. So taken in aggregate, what I'm really trying to say is that once we throw all these factors into the mix, which warrant their place because of their predictive qualities, we find that the dial over here sits in moderately positive, and I can explain in just a short while what that means with regards to an actual place on the yield curve. But this is formally how we ascertain our score.
So this moderate overweight that you've just showed us, can you explain what that means in terms of where we want to be positioned on the curve at this point in time?
Yes, absolutely. So one of the benefits of having a systematic process is that it lends itself to empirical backtesting. So what the broad idea of what we try to do then is that, as I explained, we are in a moderate overweight stance, and that stance is informed by our multi-factor model, right? So what we then can do is that we can say, looking back historically, we can say that, okay, the stars have aligned in a particular way to generate a moderate overweight score. Let me see what has happened in all the previous episodes in which the stars have aligned in a similar way to also generate a moderate overweight stance. And let me see then what has subsequently happened to the yield curve, and use that as my predictive yardstick to actually see which place on the yield curve is optimal. So if I could just go onto another chart just to show you and bring this to life. So what you see in the screen in front of you is basically a distribution of sorts, and what this distribution is. This is shown in the background in blue. This is labeled moderate overweight because, as I mentioned, the state of our model is in moderate overweight, and what this is a distribution of subsequent yield curve changes over the next 12 months whenever the model has historically been in a moderate overweight setting as well. So what we can see here is that you clearly have somewhat of a bell shape to the distribution, in which you can see that the real fat of the distribution, or around 2/3 of the distribution, indicates towards compression. In other words, it would be a statistically correct assumption to say that every other time that the model has been in moderate overweight, you can expect some degree of compression. Of course, there are other outcomes that could materialize. For example, if we look at the right tail of the distribution, you can find a situation in which, even in a moderate overweight stance, you do find unpleasing outcomes, like the yield curve selling off by 100 or 200 basis points. And similarly, on the left tail of this distribution, you can find very bullish or very pleasing outcomes in which, given the state being moderate, you can have the yield curve compressing by 300 or 400 basis points. But we don't like to look at that, but it's not statistically necessary to look at the tails of the distribution. What we simply do is that we take an average, right? And we can see then which bonds then perform better using this distribution and using this average, right? So what I've got here, I've just used two candidate bonds, which is the 2048 and the 2048 being an ultra long, very high duration, very high convexity bond. And then you have the 2037, a somewhat shorter bond with a little bit less duration and a little bit of less convexity. So what we can see visually from this graph is that when we do have material compression, the 2048, because of its duration and convexity attributes, tends to outperform the 2037 quite handsomely. The two perform quite similarly if the amount of yield change that one expects is not too much. And then, of course, you have the 2037 outperforming the 2048 if you have a very adverse outcome, if the yields sell off by, let's say more than 1%. So this is the sort of a decision-making tool that tells us which bond actually performs best given the state of the model, using the historical record as an indicator for what is likely to happen.
Thanks, Reza. So looking forward to the new year ahead, what is your outlook for SA bonds?
Thanks, Natalie. And I think it's a given that there will still be very high levels of uncertainty, and that financial markets will still remain extremely indexed to the evolution of monetary policy in locations such as the US, but also Europe and China. But I think that whilst there is uncertainties abound, I think that with every uncertainty comes opportunity, and comes the opportunity to take advantage of market dislocations, right? So with regards to bonds in particular, I think we'd like to just mention two sort of key attributes of bonds in general, and particularly the long-dated bonds. The first one is that, true of all bonds in general, is that they offer contractual coupons, right? So you will get cash flow twice a year, typically on a sort of biannual basis. And the other one is that bonds have to trade at par at maturity, right? So longer dated bonds, and certainly in South African context, typically trade at a discount, which means that as you move through time, the price of the bond, being typically lower than 100, needs to converge back to its face value. It needs to converge back to 100, giving an investor an accretion of return along the way. And also this idea that you get contractual coupons come what may. So you even find that in a situation, and last year was very much a point in case of this, you even find a situation where even if yields do sell off and you're prepared to hold the bond through time, it's not a terrible outcome, simply because you get your contractual coupons in an environment in which yields are selling off, so you can reinvest coupons at ever higher yields and lower prices. So what that means, if you run the maths, what this actually means is that you can actually then, you can compound an effective rate, an effective yield that is higher than your initial purchase yield of the bond. So we think that is a very powerful sort of mathematical anecdote about bonds, but which works in an investor's favor. So I think with that, I'd like to sort of close off my comments, and I think that hopefully 2023, proves a less bumpy ride than certainly 2022 was.
So we've discussed the Fed pivots, we've discussed inflation potentially peaking, but in Q4 we still had a rise in interest rates. So I'd like to go over to you, Henk, and talk about the income provider portfolio. So how has the portfolio been positioned? And how are these higher rates affecting the performance and performance outlook of the fund?
Yeah, thanks, Natalie, and to my fellow panelists, Bastian, Reza. I think you've painted a great macro picture, brought it a little bit closer to home on our bond curve. But maybe let's focus more than on the front end of the yield curve in the South African context. As you said, rates still moved higher in the front end of our SA curve. So if you think back to November, we had 75 basis points of interest rate hikes. But it goes back to a comment we made in our previous webinar, where rates going up in the front end doesn't necessarily mean that you would lose money given where you are positioned. Similarly, you saw flatness in our curve, and I'll show to us a little bit later in the picture. But where we've seen the Fed, or the market expecting the Fed to cut in the US sort of 2-3 years out, we've seen something similar happen in our SA market, where our 3-year rates have certainly collapsed. Front end is higher, but there was opportunity to make some money in that space. And if you think about the returns of the fund, Q4 was a very strong quarter, opened up some risk budget, allowed us to take some more risk, and certainly what we've seen being positioned in sort of more fixed rate exposure in the front end certainly paid off. We've moved out of that now, focusing more on the front end, a little bit more on the back end, not in that belly part of the front end of the curve. And certainly with the yields being where they are, looks like a solid footing to start the year with. So let me show you in 1 or 2 charts what I've said. I'm going to use some of Bastian's charts as well, looking at the US curve relative to SA, but certainly some fascinating moves even in our front end of our yield curve. Okay, so what are we looking at here? It's a favorite of ours. It's basically what the market in South Africa expects our interest rates to do. So just switching off a couple of these guys on the side here to give us a clearer picture. This is what the market was expecting about 6 months ago. You can see a very steep curve, a very aggressive hiking cycle, as we have already said. This is where JIBAR is currently, so we have moved higher. Again, speaking to sort of Q4, where we saw again another 75 basis points hike. This is a month ago, certainly a lot flatter as the market moved. And very interestingly now, if I do that, you can see how the curve has moved in the front end, but sort of dropped in the belly of that curve. If I then move into the belly and depict it in a little bit of a different way, taking that rates that I've just shown you now. So where does the market expect that rate to go? That's this red line over here, the 3 months rate. This is the expected of that rate over the next 3 years, so the 3-year swap rate. And the difference is really what the market expects rates to do, or how much am I getting paid for taking risk in the front end of the yield curve, and that's the spread. And you can see not very long ago, almost 3% of interest rate hikes, and that is completely compressed to almost nothing. Basically telling me that I'm earning the same in the 3-month space than in the 3-year space, and not showing a lot of value in that area of the curve. So what we've done, we were positioned in that sort of 3-year area. We've moved some of our fixed rates exposure to the 1-year area, and then a little bit in the back end, but I'll have a talk about that in a second's time.
So given how the fixed income environment has changed, can you explain to us how the fund positioning changed over the last quarter?
Yeah, perfect. So as I've already mentioned, moving away from 3-year to 1 year has been a key change, but similarly and aligned with what Reza has shown us, how we've shifted from complete max overweight in the bond side, or at least on the duration side, moving a little bit more into a moderate overweight, or maybe looking towards the uncertainty, wanting a little bit less risk. We've also adjusted the way we've taken our duration exposure in the income fund to focus more on the belly of the bond curve, and more specifically 2030s, and some of the bonds that the bond fund would also look at 2037s. This is basically saying that we don't expect necessarily material changes in the level of the curve, but we want to try and take advantage of some of the other attributes, as Reza said, pull to par. Certainly with the steepness of the curve, you want that roll down. Bonds that benefit from that is where we've tried to position the income fund. But let me show you that in a picture or two. Okay, so specifically thinking about the income fund, obviously we have a little bit of a different risk hat on when we're taking on active risk, or duration in this case. So what we've done, and we've explained this a couple of times, is really we're looking at 2 attributes of a bond here: the total return of the bond, so that includes the roll down to coupon, etc., as well as sort of a risk-adjusted bond attribute. So what we've done here is to add a bit of a Sharpe ratio. So when we're taking on a duration in our fund, that is the 100% optimal portfolio given our duration stance. We split it into 2 different categories: total return and a risk-adjusted return. Quite a mouthful, but basically if we still it down, it picks a couple of bonds for us that meets those attributes. And currently what we can see is it likes the 2030 bond, so basically the sort of 7-year area of the curve where it's quite steep, and it wants to bring in a little bit over the back end or belly 15-year area of the bonds where the yield pickup in the curve is also a little bit steeper. So what we've done in the portfolio is to shift away. You would recall we had some 186s, which was more in the front end. We've got rid of those, moved into 2030s, and started to introduce some of the back-end bonds to take advantage of what we still see as elevated yields and an opportunity to earn some great yield in this portfolio.
So as we navigate these uncertain times, risk management obviously becomes a very important consideration. So how are we managing the risk in the fund to make sure we are still delivering on that capital preservation target?
Yeah, great question, and I think we've said it a number of times, all of us today, that uncertainty is still with us. That's one of the sort of things that we've inherited from last year, and having that capital preservation mindset in the income fund is something that we certainly think that sets us apart. So what do I mean by that? Clients simply in an income fund do not want to lose money. And we allocate a rolling 3-month period to that. So when we try and protect capital, we take a 3-month view, say we don't want to lose your money over any rolling 3-month period. With that comes a lot of nuances. Basically, we need to think about how much yield and return do we have in the portfolio to be able to spend on risk. That's the one key area. And then the second one that's probably a little bit more important but not as well understood is how much risk am I actually taking in the portfolio currently. And that is where we've done a lot of work, and certainly, as I said, we think that's where we are set apart. But let me show you a little bit more detail. It's a little bit, it comes across slightly complicated, but the concept is very simple. We don't want to lose money. Let's measure how much risk we are taking. So let me show you that. Okay, so as I said, quite a number of numbers to look at. But in simple terms, is we've calculated how much budget we have. So it's either the next 3 months of yield that we've built into the portfolio, 2 months of yield, or last month plus last month's return. 1 month yield, 2 month return, and then the fourth one being a sort of an intra-month. We need to know where we are currently. If we look at those 4 numbers, it gives us a sense of how much budget we have, and then we need to think about how much risk are we taking and how much risk can we take. And when we were strongly overweight, when we chatted to you guys last time, we were targeting a 99.5% risk level. We've moved slightly over to the 99.9, and these 2 numbers, so the most punitive risk number, budget number, the 3-month yield, and the risk number, very, very close. That's not a coincidence. It's how we're trying to achieve our risk number. And basically what it says is how much risk we are taking in the portfolio isn't more than what we actually can take and jeopardize that risk target of ours and try and achieve that rolling 3-month positive number and not lose your money in the income fund space, certainly in a time where there is still some uncertainty around.
So despite the tough environment, the fund still performed well over the last year. What would you say were the main drivers of this performance, and should we be expecting any changes going forward?
Yeah, so in the income fund, we're always trying to find diverse drivers of real return. So we have a big and large toolkit or large tool set that we can use. And very pleasingly, if I look at the contribution or attribution of returns throughout last year, all the different building blocks contributed positively. So that is the first sort of tick box, that all the drivers that we are using actually adds value. Some of the key, more sort of key drivers, certainly if you look at Q4, yes, the duration helped the fund, so our fixed rate exposure did quite well. Some of our good yielding assets, so some of the credit we incorporate into the portfolio did well, and certainly preference shares was still a good asset class for us. One that wasn't as attractive, or certainly hasn't performed as well as we expected, and if you think about the comments Bastian made around where global rates are and certainly where the Fed rate still is, and Reza alluding to some of the emerging market bond sort of returns of last year, the offshore component in the income fund certainly was a little bit more of a laggard, still contributing positively, but not as much as one would have expected. But that is a good thing going into this year. If I think about some of the sort of opportunity sets, certainly in the front end of the global curve for SA rates in the global space, there's a lot of opportunity there. And the fund yield being close to sort of 10% is obviously a great starting block. So we joked about it yesterday, but certainly if nothing happens, it would be a great year for income, earning that yield of 9.5 to 10% with a very, very low heartbeat. It's almost exactly what we're trying to achieve. So let me show you 1 or 2 of the opportunities that we do see, and some of the things we are doing in the portfolio looking forward for this year. That's certainly a year that we think income is a great place to be, given the uncertainty, but the high elevated sort of nature of yields you're starting with. Okay, so a very simple chart to look at, and again, trying to tie in everything that we've said today. What we can see is two yield curves, the one being SA bonds issued in the offshore market, hedge back into rands, and then compare that to the local bond curve in rands. That is the offshore one, and that's the local one. And what's very evident here is the nature of the way that the market is pricing rates to move globally. There's a big opportunity still for us in the front end of the offshore yield curve to buy some dollar assets, hedge it back into rands, don't take that currency exposure, but create a yield pickup for ourselves in SA names we like, but certainly that will add value above and beyond what we can find in the local market. As we're moving away from taking some active duration bets here, we certainly want to find yield opportunities, and this is one that's sticking out for us currently.
Thanks, Henk, and thank you, Reza and Basti, for your time today and all of your valuable insights. Thank you, everybody, for joining us. We will now take some questions. Good morning, everyone. Thank you for joining us, and thanks so much for sending through your questions. We've got some great questions here, so we're just going to jump in. I'm going to start with a question on the fund-specific stuff. So our first one is, how does the income fund differ to the flexible bond fund?
Yeah, I'll take that one, Natalie. The main difference here is obviously the risk budget. Okay, so our income provider fund is very risk cognizant. It basically makes sure that there's never any loss of capital over any 3 months rolling period. That has obviously protected us very, very well in the last year, and that basically shows that there's a case for such a strategy. And then within this, I want to call it constrained framework in a positive way, because it just framework makes sure that they can't lose capital. Within this framework, we basically eke out as much yield as possible, which works quite nicely right now because the shape of the yield curve is really favoring the front end. Okay, so then on the flexible bond side, the strategy is, as the name says, very, very flexible. So risk is here not necessarily the first decision-making tool. So we are very willing to take risk, but then we can basically expand out into long duration assets if we deem those as more attractive, or if we expect the curve to shift down, or if we expect the curve to flatten. Then we will make very bold calls at the back end of the curve. So more flexibility. More room almost to basically create higher returns over the long term, but obviously this comes at a cost, and the cost is a much higher risk. So 2 fixed income strategies, 2 of them are best house view, the one on the front end, the one on the back end.
Thanks, Basti. Okay, next question. What is the chance that SA will do haircuts on bonds in the future? Taking Eskom debt on is a problem.
Okay, thanks. I'll respond to that. Yeah, we think that the actual chances of haircuts are very, very small. One of the redeeming things about South Africa as an emerging market location is that most of our bonds, in fact, around 90% of the debt issued is issued in rands. So we think that for a sovereign that is issuing, excuse me, it's issuing most of its debt in its own currency, there's actually a very small historical precedent for them actually doing haircuts or defaulting on a bond in its own currency. I mean, there's a small number of examples in the past 60 or 70 years in which we've had that. So we actually think that the level of almost like financial penetration or financial absorption of South African bonds are very, very much higher than in other emerging markets. The banks own a great portion of it. The insurance sector owns a massive portion of it. So we don't think that the South African government will do haircuts on bonds, given that it's issued in rands, and given that it's such a systemic part of the financial setup here. Yeah, and with regards Eskom, I see there's a follow-up there. So with regards to taking Eskom onto the sovereign balance sheet, I mean, what I would comment here is that, I mean, there's obviously lots of uncertainty with regards to, maybe separation of divisions of Eskom and things like that. But the reality is, if you look at Eskom debt, I mean, a large portion of that is already government guaranteed. So it's not going to be like there's this watershed moment now, and it's now not Eskom's problem anymore. Now it becomes the sovereign problem. It's not that at all. It was always, in some sense, for a large portion of the debt, always the sovereign's problem, given that it was government guaranteed. So I don't see much of a step change, with regards to certainly in the yield curve, if it would be the case that Eskom formally, shifts his debt onto the sovereign's balance sheet.
Thanks, Reza. Okay. MPC meeting is today. What is the market expectation? What do you see happening, and how is this going to affect the curve?
Yeah, I think it's probably appropriate for me to take that one. Yeah, obviously a great question. So what I would like to do is just quickly show you guys on the sort of screen again, go back to one of our favorite charts, and see what's actually priced. So what's the market expecting? So from our perspective, I think it's probably fair to say that they'll move by 25 basis points. If we think what sort of price, that's probably in line. But more importantly, I think the statement and what they predict, or at least try and see if going forward, is almost more important to get a sense of what will happen to the rest of the yield curve. So let's just get into it here. Get to the SAR pricing, and then happily switch off a couple of these guys here. Okay, so you can see the front end here. So basically, this is where we're starting. The current JIBAR rate, if you think about repo being about 7, JIBAR's already drifted towards sort of indicating that there will be a slight increase. And if you think about where we are, so this is more or less where they're pricing. So from about 7.3 to 7.6 indicates more or less 25 with maybe a slight risk of more. So that's sort of consensus and probably what happens. But as I said, I think the statement and what the statement means for the rest of the curve. So either bringing in this thing maybe a bit lower, and that's probably our base case, that we won't see as much hikes in the front end, but also then specifically what happens to this back end. Do we start expecting them to start reducing rates? Probably unlikely. So do this thing flatten out? So it's more important to listen to what they say, how the curve reacts, rather than getting right how much they'll do. But as I said, probably consensus on 25, and that's probably what we'll see happen.
Thanks, Henk. Okay, so someone has said here, Bastian, you spoke a lot about inflation coming down. Doesn't the reopening of the Chinese economy pose a risk to this view?
Yeah, that's correct. So it does pose a risk to our view. So certainly the reopening of China could lead to a little bit of an upswing to global growth, and with that upswing, also a potential upswing to global inflation. The concern here is that obviously China consumes a lot of commodities, and then this will issue pressure on commodity prices, etc. So answer is yes, that is potentially a risk. The reopening of China is potentially a risk to inflation coming down and might keep inflation up. But and I think that's very important. There are other factors which could easily dominate the inflation theme or how inflation pans out. For example, if we see more of a global downswing or more of a global slowdown, then that will definitely outweigh basically the impact of the Chinese reopening. And I will also say the Chinese reopening has become quite a bit of a consensus trade. So everybody's betting on this reopening. We track the data slowly, carefully, and we have seen that this reopening has happened quite slowly. So yes, markets have partly priced for this. Yes, we saw a steep recovery in emerging markets, which is nice. But the economic data is not as clear-cut how strong and how pronounced this reopening will be. So long story short, yes, there's a risk that the reopening will keep inflation higher, but I don't see that as actually all that likely. There's other factors which potentially are bigger.
Okay.
Yeah, so just maybe a quick comment, not on that specifically, but a comment that was made around my socks and how do we choose those, just to keep it light and simple. Obviously, the macro environment we're working with is one of load shedding, and often we have to get dressed in the dark. So that's what I'll say about that.
Thanks, Henk. Great question there. So the next one, I understand that bond yields moved against you, but does this not indicate that your modeling predictions failed? Would anyone like to take that?
I'll take that one. Maybe we can just go to the part of the portal that just shows the distributions. Thanks. Yeah. So let's perhaps just go here, and then let's just go here. Yeah. So great question. Thanks. I'll take that. So what we try to get across in the webinar is that we don't make predictions on what's going to happen per se, right? So if I were just to show you, because the example I quoted in the webinar itself was on moderate overweight, what we simply are saying is that we try, being systematic and data driven in nature, we try to let the empirical experience speak for itself. So the model, the model has a score of moderate overweight. So what we've simply done is that we looked at 25 or 30 years of history going back, and said that, okay, every other time that the model has been in moderate overweight, what has been the distribution of outcomes with regards to yield changes. Now, yes, the yields moved against us, but if we actually look at this distribution, we can see that basically having almost like a 1% sell-off occurs in the tail of the distribution, right? So let's just make things a little bit easier. Let's just say that you've got 95% of the distribution here. That's the real fat of the distribution, and then you've got 5% in the tails. Now, is it correct to say I'm going to rather build a portfolio based on something that happens 1 in 20 times? Or is it correct to then build a portfolio, based on what on average happens 18 or 19 out of 20 times? So we've obviously taken the approach to say, let's see what happens with the greatest amount of statistical frequency and basically select on that basis. Of course, you can have very adverse things, but the chances of that are statistically small. Similarly, you can have a very, very bullish outcome, something that is also very statistically small, but we build portfolios based on what happens in the fat of the distribution 80 or 90% of the time.
Thank you, Reza. I think that is all the time that we have for questions today. If we haven't managed to answer your question, we will try and send you an email and get back to you. Thank you so much for joining us, and have a great day further.